The S&P market is obviously quite strong, so strong that any minor cyclical pullbacks are likely to be negligible and almost non-existent. Today is October 28th. In our last video, we mentioned October 28th as a particularly significant date because 4 or 5 different cyclical influences were all changing on the 27th or 28th of October. It looks like the low that we were expecting came in actually on Sunday night on the 26th, and the market gapped open. The S&P futures gapped open on Monday the 27th. The S&P futures don't gap. Yeah, the ETFs will gap, but the 23 hours a day traded S&P, rarely do you ever see a gap, a 50-point gap on the open. Most of these gaps are filled. The S&P almost always fills these gaps on the futures. So this is an unusual scenario, and it could very well be that we're entering the parabolic phase of the up move that we've been waiting for and the super bullish phase. Now, on the positive side, we said that the seasonals, that the 28th of October was generally a very statistically likely point for the low, that ultimately the market should go up about 75% of the time. It'll go up into next May. And the Venus position also had a low on the 24th and also indicates a 4 to 6 month potential up move. And the 60-year cycle is in an up phase, and the 18.6-year cycle is in an up phase. Both of them go on until next March, okay? So the big cycles are pushing this market up. And this is what's called a bubble. Many technicians use that term. And you'll also hear them say, well, we don't know how long the bubble's going to last. But with the utilization of the cycles and awareness of the momentum, real indications of actual momentum, you can see that the market still is going higher. Even though the fundamentals may be miserable, even though many expert economists will find 1,000 reasons why the stock market should not be going up. And some of the largest institutions in the world are not really fully invested in this because they don't believe it. Nevertheless, when, there's that old song by the Jefferson Airplane, White Rabbit, when logic and proportion have fallen sloppy dead. In other words, when all the rational events, all the rational reasons for something are not happening, it's still happening. The bottom line is this is an emotional rally. It's based upon the FOMO. Public is buying. And even them, they're not even fully invested at this point. So given we're at all-time highs, we're at cycle lows, and for the most part, those cycles are big, this market could go significantly higher before it's done. And we're looking at by the end of the year, potentially 7,600 and possibly even a high even later next year. All right. Now, that doesn't mean it's going to go up every day. As a matter of fact, we're having a hard time because there's still potentially a cycle high in the next day, and it should come down a few days. But every time it's supposed to come down, it comes down a tiny amount. We broke above 6,800, which was an important resistance level. It stopped the market for a long time. And now it's very possible 6,800 will support the market. 6,830 is where the gap would be closed if it went back down there. And we've gotten up to 6,944 today. So we significantly broke above 6,800, so much so that a pullback to 6,800 would just be a 50% correction on the most recent rally that started on the 16th. So it's still possible this week or in the next few days that the market will pull back and go back down into the 6,830 or 6,800 area, which would become support and would be a decent sized correction. It could be a 2-wave correction of whatever started. Looks like a 1 wave of the 5th wave probably started last week. And you can expect that we probably will not see any prices under 6,700 if the most bullish scenario is in play. If something less bullish is in play, then we'll see something lower than that. But we're thinking it's a small probability. And so we are in very good condition to buy on any dips. The dips of 1 or 2 days, that's all you need. If it has a 2-hour dip, it may be too little. But the bottom line is you want to be buying this market and you want to stay in this market and you don't want to be afraid of it. And even though we're quite bullish and we're telling people to buy, it is important that you always use stops in your positions, you manage the risk in accordance with your capacity to handle risk, and oftentimes it's a good idea to hedge because you can buy such inexpensive hedges now. The option premiums are so cheap, particularly the short term, that even if you lose a very small amount. And if you win on the highly leveraged options, you can offset a couple of days or even a significant breakdown in the market for a week or so. So we don't expect it to go straight up, but we do expect it to go up. Also, we're going to be having another market forecast mastery class starting November 16th. And if you want to find out more about that, there's a review of the course in the most recent Traders World Quarterly magazine, which I think you could learn quite a bit more than me talking about it. The links are in the description below. Okay, so cyclically, what's going on? We're looking at the 60-year cycle continuing on its merry way up. We're looking at the 18.6-year cycle, which basically is in 2007, running up into the high in 2007. That would line up with March or May of 2026 as a final high. It gives us some clue as to where this momentum will end and where this cycle is likely to top out. And we're expecting a bear market after that. In other words, next year ultimately will probably be a down year, but it won't start immediately. It probably start after the first quarter, maybe in the second quarter, and then go down dramatically. And the super long term, this kind of FOMO thing has happened over and over again. You know, most of you haven't been trading long enough to notice, but you had the same thing in 1999 and 2000. You had the same thing in 1969. You had the same thing in 1937, 38. You had the same thing in 1907. Roughly every 30 years, 31 years, you get a very, very important reversal in trend. And that is ultimately not yet ready. In other words, it still could last until 2028. Even if we go down hard next year, it could still go up again. You know, the market's not done. It was 1996, then Alan Greenspan mentioned the term irrational exuberance. The end of 1996, he's talking about the public is buying and the market shouldn't be going up, but it is. We're having the same thing happening right now. The market topped out 3 years later, okay? Okay, so we've been looking for a low on the 27th, 28th, 29th of the month based on the short-term 2-month cycle and also based on the exact repetition of 18.6 years ago. We didn't get a pullback. Instead, we got an explosion. And even though that may not seem like a low, the truth of the matter is in cycle work, you can see that a lot. When the market's supposed to make a low and it doesn't come down or just goes sideways, then it explodes upward. The cycle is just kind of exploding in the context of an upward trend already that's strong, and it adds an extra oomph to it, and then you get these gaps, which we just saw. So the lows we're looking for right now, there's still a possibility of a lower on the 29th or 30th, a couple of days down. Not big, but something. And then there's another high point expected on the 10th of November, another low around the 13th of November, which may or may not be lower. And then there's one around Thanksgiving, around the 24th or 27th of November, and then up. We expect the market to go up until the end of the year, early January, before it stops. Now, what's interesting is, astrologically, for those who are interested, a number of bullish influences are all in play now, okay? The Venus cyclical low at 24 degrees Virgo happened today. The Sun cyclical low at 10 degrees of Libra happened today. These only happen once a year. This causes the seasonals, okay? And the market exploded the day before, you know, but that can happen a day early. So that's one thing. The other thing that's interesting is the Mercury position. If you look at Mercury's position last year, it has been repeating very, very much what happened this year, going back 246 trading days on the futures. It's extremely highly correlated with the whole move since April and even before. And that says basically we may have a dip for a day or two, then we shoot up higher. The next high is December 4th, and then there's a pullback, another high in early January. So if you follow 246 trading days, you may get kind of a reasonable roadmap for the shorter term stuff. Again, none of these things are going to be accurate necessarily to the day. And if you're day trading, you can't rely upon these things exclusively. All right, but hedge your positions. It doesn't cost much to hedge nowadays. The Mars position is now aspected by Jupiter, which I thought to be a minor high point, and it still might be for a few days, which means we could have a pullback. Jupiter is in the sign of Cancer, which is a very special sign. It's its most bullish sign, generally speaking. And this year, it aspects Mercury right now, and Mercury is the controller of the New York Stock Exchange in terms of the astrology, which means when Jupiter aspects Mercury, it's bullish. And it'll stay bullish for at least another 2 or 3 weeks. And then even longer, because Mercury goes into the sign of Jupiter in Sagittarius. It's also bullish because it aspects Saturn, and Saturn tends to have a conservative, fear-based approach to trading. And when Jupiter aspects Saturn, even the conservative people, even some of the large institutions will start jumping in, which they have not yet, okay? And Jupiter aspects Mars, which ultimately could wind up being a bullish influence in the long run as well. So Jupiter connecting to all these planets, Rahu in a position which 18.6 years ago has been repeating very high probability, and it goes up into next March. And the Jupiter-Saturn 60-year cycle is clearly bullish. We can't say anything other than you got to buy pullbacks. When they'll happen exactly, difficult to predict exactly. So this is an unusual, weird, strange market. And because it is, people have a lot of different opinions, a lot of different rationalities. But our philosophy and our methodology, which has helped me for the last 40 years be on the right side of the market, is the cycles are repeating. The patterns in the cycles create the emotional backdrop and the interpretation of the fundamentals that are driving the market. It's not only the fundamentals. It's the interpretation that is assigned to the fundamentals. That's what the stock market is. The stock market's not the same as the economy. It often leads the economy, okay? And people who are understanding it only from the point of view of weakness in the economy or recessions coming or whatever, these are oftentimes not capable of timing anything. They can get it right, but they're off by 2 years, you know? So the idea here is using these cycles give you a huge edge. And basically, I'm teaching people how to find those cycles. It's a really cool thing to learn, and it's something you probably would enjoy, and it undoubtedly will improve your trading.